Welcome to our investment portfolio analysis and report. My name is Daniel and I'll be taking you through the investment strategy portion of our report. To initially choose the asset allocation for this portfolio, we use the top-down method. Top-down method is an investment analysis approach that first identifies the macro picture in the economy using such measures as inflation, interest rates, GDP, currency movements and other parts of the economy. It then goes on to look at smaller aspects like general market conditions and various industrial sectors, so we can better select those that will outperform the market. We looked at the company's fundamentals and we chose for this portfolio and chose those that not only fit with market trends and had potential growth, but also aligned with our clients' preferred investment strategy of passive conservative, with the added stipulation that any potential investment had to be ethically sound. We concluded using this approach that companies such as Microsoft, Google, and Roper Technologies, etc. all fit these criteria. This approach prioritizes macroeconomic factors the most, which is why we chose established multinational companies in good standing and in the appropriate sectors to invest in. Our investor falls into the low to medium risk tolerance range. Our investment strategy for this report is passive as well as conservative. Conservative investing is an investment strategy that's main focus is to at least preserve or ideally increase a portfolio's current value by investing in safer options such as term deposits, international deposits, and high-end blue-chip stocks. While this investment strategy protects against inflation, it will have much smaller potential growth than a riskier approach. First and foremost, our client is very ethically minded, so we would be choosing relatively safe investments. We must also keep in mind the mission statement of our companies we invest in and whether they are having a positive effect on the world. As part of this conservative investment strategy, we'll be focusing on the preservation of capital by placing 30% of our total investment into term deposits and international deposits, returning 3.1% and 2.8% per annum respectively. This means that for the period of the 18th of March to the 3rd of May, our client receives guaranteed return, which in a worst case scenario could be used to offset any potential losses in common stock. We also employed conservative investment strategy during the time frame we had. As passive investors, we kept the amount of buying and selling stocks to a minimum during this time, which makes this strategy extremely cost effective because of reduced transaction costs and time spent managing the portfolio. This strategy requires a buy and hold mentality and requires us not to react and act when small fluctuations in stock occur. The strategy is best used over the long term. We chose passive strategy to manage the portfolio because it has several key benefits. Firstly, we bypass a lot of potential capital gains tax because we are buying and holding stock. Therefore, this strategy is tax efficient. Secondly, this strategy is very transparent for our investor to view and analyze whenever he needs. Also, oversight by us is far less expensive than a more aggressive strategy because we are not picking and changing stocks constantly. Passive funds usually follow the benchmark made by the index. A limitation of this strategy is a small potential for returns, but that is in correlation with decreased risk. By definition, passive shares will never beat the market by a significant amount. Some people believe that passive investing strategy is trumped by professional money managers' ability to read and predict the markets. But this is normally false. Looking at performance results done by several studies, passive investing works. On a very small number of funds, only a very small number of funds outperform the passive investment strategy. We set out with the goal of maximizing our clients' investment value over a certain period, knowing that they wanted to be conservative to minimize risk and that the investments chosen had to be ethically minded. Knowing this, we selected different securities using the top-down approach and used the passive investment strategy to manage the portfolio. The results of this and our evaluations of our performance will be found later in this report. Thank you.
Hi, I'm Naziam. I'll be talking about security selection for assignment. Security selection is the process of selecting specific securities within a given asset class. The initial investment of US 1 million was allocated as follows. 700,000 was invested in the share market, 250 in the term deposit, and 50,000 in international deposits. The term deposit had an initial rate of 3.10% per annum while the international deposit had an initial rate of 2.8% per annum. The investment strategy included a highly diversified portfolio where 19 different stocks were selected. Next, please. Efficient Frontier includes investment portfolios that offer the highest expected return for a specified level of risk. Passive strategy was used as the investment did not include buying or selling of securities. There were 4 stocks that performed poorly, which were Nike, United Health, 20th Century Fox, and Biogen, while the other 15 stocks performed well and had a positive return. Thank you.
Hi, I'm Jessie and I'll be talking about risk diversification. So obviously because we chose to invest in the share market, being the risky asset of the portfolio, there is a risk present. As shown, there are 2 types of risks. Market risk is impossible to avoid, being inflation and the interest rate changes as it influences the entire market. However, on the other hand, because firm-specific risk is unique, it can be mitigated by constructing a diversified portfolio, which is what we did by investing in a number of different stocks to minimize our clients' risk as shown next. To maximize the use of diversification to minimize risk associated with our client, we allocated $700,000 of the $1 million funds to 19 different types of securities from differing markets. The reason for this is shown in the diagram. Risk is only minimized through diversification up to a certain extent, meaning that the standard deviation, being the measure of systematic risk, will only reduce so far until it averages to become almost the same when continually investing in stocks. As stated, diversification doesn't guarantee expected returns for the prime reason that risk will always be present. Also, by having a diversified portfolio, there is a risk that some stock returns will perform excellently and others the total opposite. For example, we have Biogen with a negative 29% holding period return and Tiffany & Co., which was the total opposite with 12.532%. In turn, there are limitations on the expected return as it is potentially lowered once being averaged out, where we have an approximate portfolio share market return of 0.739%. Although on having the limitation, diversification does minimize risk and provides a basis for the risk associated to expected returns. The standard deviation is low, however, and doesn't deviate from the arithmetic mean too much, demonstrating further that the dispersion of risk has been minimized, resulting in a stable portfolio.
Hi, I'm Jordan and I'll be talking about stock selectivity within our investment project. Stock selectivity is one's ability to pick a good performing individual stock based on a risk and return basis. So with our clients' morale and values, we actually picked environmentally friendly stocks like Ecolab and Atlas Energy. So these are because of the huge societal pressure currently going now where people are looking for cleaner, greener energies and environments and whatnot essentially. We saw these 2 stocks as growing trends as well, with their stock picking up over the last 4 or 5 years. Technologies like Roper Technologies, Microsoft, Alphabet, PayPal, and Broadcom, we've all picked these because over the last year and a half, we've actually seen them grow, especially with the fall in December in 2018 with the majority of these major, huge tech companies. We see this as a capitalization area where we can actually grow and make huge profits and gains because a lot of these companies have seen that huge dip in December. Moving on to our healthcare market, we're talking about Johnson & Johnson and Biogen. Very similar to our environmentally friendly stocks. We see this as a huge market where we can actually grow people because they are based on medicine as well. These are all American-based companies where they actually will see a lot of the majority of spending. Moving on to our media, moving on to our media like Netflix and 20th Century Fox as well. We picked 20th Century Fox because due to their most recent movies coming out, especially with the hype behind the X-Men movies, we could possibly see a huge gain in terms of the share prices, as well as Netflix with a lot more investment coming in, and a lot more documentaries and a lot more subscriptions coming towards them as well due to streaming, more people streaming TV now, using more streaming services. Other stocks like Nike, Starbucks, and Xero, we've actually picked them because we've seen a huge trend behind them. So in terms of Nike, we picked this stock in particular because we there's a huge hype behind a huge college athlete named Zion Williamson who has prepared to sign with Nike, and this could see a huge bolster in their stock. This is ahead of their fourth quarter American sales report, as well as Starbucks and Zero, because we see this as just a trending market essentially. We'll move on to our next slide.
Hi, my name is Kate Tennant and I'm going to be talking about the performance of our portfolio. First up, we have our actual return of our shares. So, idiosyncratic risk was arguably the biggest factor that contributed to our low return on our portfolio. Idiosyncratic risk is a risk that doesn't affect an entire market, but rather a specific asset or stock, like our Biogen, which actually lost 29.022%, and we've lost around 17,000 on just that single asset alone. We analysed our data using HPR, which is the end of period value, take away the initial value, minus the initial value. This is our return for our entire portfolio, including our deposits. So in our term deposits, we actually lost money on our international deposit. I'll show you why that is in the next slide. So we invested $50,000 US dollars into New Zealand dollars, so making $73,000, invested at 2.8%. For a holding period of 7 weeks, made $275.15, transferred back to US dollars at the later date of May 3rd, we actually lost $1,638 on this, so safe investment. We analysed this portfolio in several ways, one of which being the Trainer ratio, which was based on the risk-free rate. So the risk-free rate was taken from the Treasury bill rate of 2.46, calculated down to 7 weeks, 0.33, which actually means we performed worse than the risk-free rate. This is a Sharpe ratio, another way to test performance of a portfolio. A negative ratio in this case also means the risk-free rate outperformed the portfolio return. Negative Sharpe ratios will not persist for indefinite amounts of time, as capitalist economies would cease to exist if that were true. And generally, to be effective, Sharpe ratios should be taken over a long period of time to combat this, not 7 weeks as we did.
So, in conclusion, for a more effective passive approach, it actually requires a lot less volatile stocks than we've actually picked. One thing we also learned is that large multinational companies can have massive swings due to sudden announcements, like in the case of Biogen when they stopped a huge clinical trial. We end up making a massive loss. Things like term deposits, foreign term deposits, we actually made a huge loss as well of $1,638. This is due to us not knowing about exchange rates climbing during this period. And also, our climbing role actually affected profit maximization, which we could have actually done a lot better as well. So what we could have done better is active trading. So knowing during this period, which is quite a short-term period, with these type of stocks that we've picked, if we have traded them, we actually could have stopped a lot of our losses and actually made a lot more better profits. In the case of future times, we could have actually done a lot more of an aggressive approach due to the short time period we've had. This will definitely have seen a more greater profit gain, and also we could have stopped a lot of the losses as well. And if we were to do conservative again, we could have done it, we would have actually picked a lot more conservative stocks. So stocks that were long lasting, we could have done this over a longer period of time. And these stocks would have actually been low risk, low return, so we more than likely guaranteed a huge, more profit than normal. Thank you for listening to our presentation. I hope you enjoyed and have a great day.